I'm Angela Polson, staff writer with Modern Distribution Management, reporting to you from the Advanced Profit Improvement Conference in Scottsdale, Arizona. Today, I'm speaking with Jay Grayson, Principal for Supply Chain Equity Partners and a speaker at this week's conference. Thanks for joining us.
Thanks for having me, Angela.
So before we jump into questions, just tell me a little bit about Supply Chain Equity Partners and what you do there.
Be happy to. Supply Chain Equity is the only private equity firm in North America dedicated exclusively to investing in wholesale distributors and logistics companies. It's been our focus for decades as individual partners or principals, and we still remain the only exclusive distribution-focused PE firm in the country. A couple things that make us different from any other PE firm, in addition to that exclusivity, exclusive focus in distribution. One, we do not have any institutional capital. So we don't have any of the pressures that some of those institutions can put on other private equity firms in terms of when to put money to work and when to exit transactions. So we're in this more for the long term, Angela. The other thing that makes us very unique is almost all of those investors are former executives, owners, CEOs, CFOs of distribution companies. Former executives in industries ranging from healthcare to consumer products to industrial MRO from a market perspective, with business models ranging from branch-based kind of brick and mortar businesses on one side to direct marketing companies, be they internet businesses or catalogers on the other side, and mixed models in between. So it's all different types of industries, different models, and all throughout North America. So again, what we do is we look to partner with top management teams and try to work together with them and find ways to accelerate growth of the business and help improve the value of the business.
Great. Could you provide an update on the current M&A market and just kind of project a forecast for the kind of conditions that we can expect going into 2013?
Sure. Maybe the best thing to do is start with 2012 because, as I think a lot of people saw, and it was expected, there was a significant pull forward from 13 into 12 of a lot of transactions just in M&A in general, and that was done largely to beat the tax man. We all knew that on the table was a very significant increase in capital gains rates, some additional healthcare surcharges that went on top of it, a lot of money to owners if they can get a transaction done in 12 versus 13. So a significant pull through there. In distribution, what was interesting is we now look at the first 2 months of 2013 compared to the first 2 months of 2012. There were actually more transactions in 13 than 12. So we in our internal proprietary database tracked 39 distribution transactions in the first 2 months, actually through February 24th of 2013, 39 versus 34 in the same period in 2012. So we do see that there has been an acceleration, a little bit what's going on there. Fewer platform deals though, Angela. So if we look at the deals that were done, while they were larger in quantity, there were fewer platform deals. By that I mean the larger companies upon which you can make add-on acquisitions. So all in all, I think it was a healthy 2012, and we went to a healthy 2013. Now, there's some dynamics in there I think that are interesting to our readership. I mean, if you look first of all at private equity, private equity still has somewhere over $400 billion of uninvested capital. And when you add that to some of the leverage that they will put on it from a bank, you get about $1 trillion worth of buying power. So there's a lot of capital yet to be deployed through private equity, and we'll talk a little bit later about some of the pressures on private equity in general, because some of the firms that only have 5 or 6 years in which to invest, remember we lost as an industry almost 2 years, 2008 and 2009, when Lehman blew up and the whole financial crisis hit. So there are a bunch of firms that are behind in their investing schedule, but really $1 trillion of purchasing power is sitting out there waiting to be deployed. And private equity still remains interested in distribution, and even more so than back in say 2006, 2007, where 6, 7, 8, 25 to 30% of all distribution transactions were private equity based. Last year, 2012, the number was 42%. So again, private equity is becoming an even more and more important part of distribution transactions. So you have that dynamic going on there. And now you add to that the strategics that are out there, because strategics have well over $1 trillion just of cash on their balance sheet. And if you look in the last few years, they've actually been delevering as well. So a little bit less debt, more cash. What does it mean? They now in the last year to 2 years have become increasingly aggressive in terms of making acquisitions. And that in fact impacts everybody here at the APIC conference in one way or another, and we'll spend a lot of time tomorrow talking about dynamic, because the competitive environment for a distributor can change overnight if one of those big distributors comes in with their healthy balance sheet, and they're under a lot of pressure, Angela, to go ahead and make acquisitions. Because they spent, if you look the last 3-4 years after Lehman blew up, first they spent a lot of time just helping their balance sheet and firming up their balance sheet. Then they started to look at how do they just kind of improve profits with the business. They had a good strong increase in revenue as the economy bounced back. Now it's a little tougher to gain revenue organically, and to support some of the prices and multiples we see in the market, they're now out there pretty aggressively buying their growth. So I think that leads into a 2013 that should be very good for M&A in general and for distribution in specific.